What happens when a serial entrepreneur who built unicorns realizes his success came at a cost he can no longer ignore?
I have children now, and it has completely changed my perspective on the world. I will overcompensate all the damage that I have caused.
For years, Fabian Heilemann played by venture capital's only rule.
As a generalist, essentially, you try to invest in any type of asset within the scope of your strategy that makes money.
What if there was a different way? What if profit and planetary impact weren't opposing forces?
We see the desire to build a large, commercially successful company that is interlocked in its enterprise value creation with its impact returns.
The old playbook is breaking down. The smart money is waking up.
My best tip is to generally stop thinking of impact as a trade-off to commercial goals.
The climate crisis isn't just an environmental challenge. It's the biggest investment opportunity of our lifetime.
Join this movement and start to gradually integrating impact considerations into their strategies. It will pay off.
Discover how one founder's radical pivot is reshaping venture capital itself. This is the EUVC podcast, Impact Series, where making money and making impact become the same mission.
Welcome to the Impact Highlight Series powered by EUVC, Impact VC, and Impact Supporters. I'm August Solliv, one of your co-hosts, and I'm the founder of Impact Supporters after having been a stint as an Impact VC in a fund.
And I'm Dougie Sloan. I'm your other co-host. I'm a impact investing LP at Better Society Capital and also co-founder of the Impact VC community. Today we're joined by Fabian from AENU. He's a serial entrepreneur. He's been a generalist VC. He's now an impact VC. So he brings a range of perspectives to questions that we'll put to him around experimenting with the structure of VC itself and engaging with the art of balancing impact and commercial return.
Yeah, and Dougie and I, we've just been sitting and chatting about what was really nice about this episode. I think we agreed that it was the honesty in sort of going real, being real, and really giving all the details in the episode. And I think I have two examples on that. And firstly, it was sort of how Fabian talked about challenges they've also had with reinventing the VC model at the AENU. They tried to go evergreen, but went back on it as they sort of fought to get institutional LP capital into that evergreen model. I think that's super interesting when you sort of believe that it's the right way to go in reinventing the VC model, but you walk back on sort of your ideas in order to also fit with what LPs want. And then the second thing is, Fabian talked about how you really they have a necessity of finding founders that believe in system change around climate and impact, and they can't just take sort of any founder. It needs to be the ones that believe in system change. And then Fabian really likes the serial entrepreneurs that have kids because they have actually realized sort of how important climate is for them and for our whole world. So hope you find this exciting. Let's jump right into the episode.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
That's a lot of information to get in 30 seconds.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Hello and welcome to the Impact Highlight Series. Super excited for today's episode. We have you with us today, Fabian. Welcome.
Welcome, August. Thanks for having me.
And then, I'm here, August Solliv, one of your co-hosts. And then we have Dougie Sloan.
Delighted to be speaking with you both today. I'm Dougie Sloan, an impact investing LP at Better Society Capital and one of the co-founders at Impact VC.
Fabian, would love to sort of just start talking a little bit about who you are, how you came to where you are now, what your focus on impact is, and hear a little bit more about you.
So, August, I grew up with my brother, Ferry, who's been my 25 years co-founder, co-entrepreneur. brother in arms also on all things climate action, climate investing these days. Grew up in a small village here in Hanover, and we basically started out as teenage entrepreneurs with a food truck, and then went onwards, law school, business school, spent early time in Silicon Valley in the 2000 years, and then ended up in Berlin, really like head first into the ecosystem around Lehman crisis, and were first of all just driven by this idea of becoming full-time entrepreneurs in what we call the internet world. And our first, after a few marginal attempts, our first bigger business was a company called Daily Deal, which was a B2C platform, basically lead generation, couponing platform, lead generation for local businesses, where we raised from inside, then sold to Google in 2011. It was a crazy story. Spent some time, 2 years with Google, learned a lot on both sides of the Atlantic. And then later started in parallel on one hand side angel investing with some of these exit proceeds. This was, let's say, around in about 100 million euro transaction. But also then started Forto with our two friends and co-founders, Eric and Mike, and Forto then later, 2021, graduated unicorn in logistics, tech, digital freight forwarding business out of Berlin. So this is, let's say, the operational side. And then after these early attempts on angel investing and getting our hands dirty, making the beginners mistakes with our own money, we stepped up, and I spent almost 7 years as partner and then also youngest general partner at Earlybird in the Berlin office, learning really in a generalist VC strategy, learning the institutional early stage VC business. And in parallel to those years, 2016 to 2022, Ferry, my brother, Ferry's and my personal interest in the climate crisis started growing. First, more as citizens, really, and mapping our personal lifestyle carbon footprint, and increasingly concerned about the growing scientific evidence about the scope, etc., which at the time was still, let's say, not mainstream or was still neglected by many stakeholders out there. And then became more mainstream maybe from 2021 onwards. And for us, then the next step was actually looking into company carbon footprinting, really in a self-taught way, with Forto, also some early bird portfolio companies. And based on that, we co-founded a nonprofit called Leaders for Climate Action, with a handful of friends from Berlin, to basically make these frameworks and this know-how available to the European entrepreneurial community. And today, Leaders for Climate Action is 2,000 plus companies and 5-6 people full-time managing this community. And in parallel, then in 2019, I also made the first attempt of integrating climate technology and climate-related considerations into the investment strategy at Earlybird, founding the climate tech investment practice. And on the back of that, with my brother then also in 2020, stepping up from the CEO role into the board at Forto to more fully commit himself to climate technology and climate activism. On the back of that, we then ended up going all in on climate tech investing, pure play, clean slate, Article 9 strategy, in-house impact team, and launched a new day, a new era in 2022. As an institutional grade, early stage European climate tech fund, about 170 million euros in size, that is focused on 3 core areas today, which is energy transition, industrial decarbonization, and also increasingly climate adaptation, also at the climate AI intersection. And that's all I do. I'm based out of Berlin, privately living, father of 3 in Hamburg. And we've been early members or contributors also to Impact VC, the community, our in-house impact team with Elena, Michelle, also formerly Melina, have always been close. So it's an honor for me to be on the podcast today.
Fantastic. And as you say, Fabian, you and your team have been supporters of Impact VC for some years. So great to be representing that on the podcast in this way. And if I may pick up on a point around your journey. So you've been a generalist VC, you're now an impact VC. Having seen both of those perspectives, what are the differences that you see? What are your reflections on that pathway? What are your key learnings, particularly when it comes to impact, from having taken those steps in that way?
As a generalist, essentially, you try to invest in any type of asset within the scope of your strategy that makes money and that generates hopefully superior financial returns. With the only borderline for most out there being what is legal or illegal. Yeah. And for some, in varying degrees, what is ethically, let's say, viable or what is still ethically acceptable. Yeah. And I think there are many areas, gaming, gambling, many forms of social media that basically promote addictive behavior, fast commerce, certain type of travel companies where these lines are increasingly blurred. And of course, all of that is legal, but is certainly not from an ethical or even environmental and societal standpoint. It is nothing that we should wish for as a society for it to be successful at scale, because the collateral damages, the money that is generated, the collateral damages are high. When we delineate that to Article 9 impact investing, and that could be on the social side, on the health side, on the educational side, on the environmental side, or within environmental, on the climate side, which is our specialization, then it's all about playing to generate attractive market rate returns in terms of TVPI, DPI, IRR, etc., that can compete with the generalist strategies out there. But looking at the benefits on the chosen impact KPIs, in our cases, megatons of carbon saved or removed that we measure on a bottom-up basis across the portfolio on an annual frequency. And so far, I can tell you for a new Fund 1, which is a 2022 vintage, it's been 12 million tons or 12 megatons so far that we've been able to generate. And looking at these impact targets and also at these impact returns, pretty much on eye-to-eye level with the commercial viability or the commercial opportunity in each market segment, but then also on each individual target or each individual investment opportunity. And that is the major difference. And that is also reflected in the organizational design, in the decision-making processes, even in the value creation. When you look at our 14 people, 2 of which on the in-house impact team that are seamlessly integrated from thesis formation, in-house research, through the investment process, all the way into portfolio management and impact value add, or as we like to say, impact as a service, rendering things like theory of change, life cycle assessments, impact measurement, impact reporting, basically crafting entire impact methodologies for the companies that we invest in and that are, despite strong intentions at their early stage, often from a craftsmanship, not yet able to do this in-house. And that is also one part of our value that we bring to the table beyond the money and also beyond the scope, like B2B market access and whatnot, introductions that you would typically expect from a generalist VC.
Hearing you talk it through, it sounds in a way like a layer you're adding on top of the traditional approach to venture capital, but actually also you're then aligning the whole firm's philosophy, organization, edge around that topic as well. So there's a spectrum, I suppose, in terms of how one could engage with it.
Yeah, no, absolutely. I think the picture of an additional layer or an additional filter set is exactly right. In turn, we are at times asked by limited partners whether that means we're sacrificing returns or whether that makes it harder to generate equal returns when you basically put an additional filter on top of the addressable and therefore smaller addressable universe of opportunities. And I think the truth is that indeed the number of addressable companies, let's say when we look into European venture deals getting done in a year, roughly, let's say anything 7,000 to 10,000 or so, depending on ways, not counting it angel or what institutional rounds, etc. Certainly, let's say 60, 70, 80% of that is for us not addressable because it doesn't fulfill our impact criteria, even if it were commercially sufficiently attractive. So indeed, we do compete or have to choose from a smaller subset that actually makes these cumulative bars. And that is, I think in all honesty, that is, let's say, the art or the challenge behind scientifically sound impact investing is actually delivering these returns while not blurring the lines or while not, so to say, deviating from your impact methodology and ending up effectively in a greenwashed generalist strategy.
And if you also then look at the founders rather, or the startups that you're investing into, how would you say the founders of the impact unicorns of tomorrow look compared to the ones of that the generalist VCs invest in? And sort of, are they the same profile as founders? Do they have different requirements in how they develop? Or what would you say are the differences?
So typically, and we've thought about this a lot, and that is also been reflected in our what we call systemic impact framework, or SIF, which is basically the core piece of the impact methodology at our firm, AENU. And it indeed, from a qualitative criteria, the first pillar, so to say, it always starts by analyzing evidence of the impact intentionality of the founder team and the top management. And typically, we see the desire to build a large, commercially successful company that is interlocked in its enterprise value creation with its impact returns, if you will, or with its impact outcomes. Yeah? That is typically what we see and what we're also actively looking for. Yeah, so intentionality, and then also interlock between commercial success and impact success, so that impact is basically inherent in the way the product and the whole strategy is designed. That is really a fundamental part of it. Additionality and impact logic, etc., are other aspects before we even start mapping and modeling the impact cases to see whether this is like a 1 megatron opportunity or a gigaton opportunity, etc. And oftentimes we see that these power profiles also are rather progressive from a cultural standpoint and have higher diversity quota on their team DNA, more, let's say, progressive parental policies and whatnot, and do not also care about the impact that their product makes, but also care about the way they operate the company in terms of travel policy, catering, green electricity, and paperless office, and heating, cooling, like all of these elements that ultimately where you walk the talk, right? And where it's about practicing what you preach and showing, demonstrating that you're in an authentic way with integrity, caring for impact while being a for-profit business, not being a charity.
And I think that's super interesting. And would you say the profiles are also the same? So, for example, you said yourself, right? You've been a serial entrepreneur, started with a food truck, and then went into the tech business and so on. Could you see the same profile succeed in the impact sphere today, or would you also look for other profiles?
Well, let's say we have a certain preference for serial entrepreneurs who at some point, and often this is catalyzed by them having children and taking a multi-generational view for the first time after having been driven by money, power, fame, like classical financial capitalist attributes or definition of success for many years, but similar to what the journey my brother and I went through. Yeah. With the only difference that we started thinking specifically about the climate crisis even before we had children. But for many, having offspring, having next generation, come to the world is a pivotal moment where they think about the implications of their own actions and how they utilize their lifetime, their energy, etc., in a way that they will also feel that it has been irresponsible and best use of their potential, looking at not only a few years, but at decades or even centuries and the legacy that they are building. So serial entrepreneurs that have a strong, say, generalist entrepreneurial skill set and are then starting to apply it in climate impact technologies. This is something I personally love, the DNA that I personally love to work with. And we are seeing this actually quite frequently. And most recently, there's actually right now we're about to close a deal in the next 2 to 3 weeks or so with where the CEO built a hugely successful, like profitable company, couple of $100 million in revenue over a 10-year period that was actually let's say, tied into fast commerce, etc. I don't want to share the name, but I can share that he, when we were first speaking, and I wanted to understand where he's coming from, what's his motivation to do what he's doing now in renewable energy. He said, I have children now, and it has completely changed my perspective on the world. And I essentially now, with this company, I swore to myself and to my little children that I will overcompensate all the damage that I have caused in the last 10 years, although I accumulated wealth and whatnot and fame and power. But I realized what damage I done. Now I want to use all my skill set to compensate this with my new climate impact company for future generations.
You've spoken quite a bit about the importance of systems thinking and systems change in your own work. And also, I think in the sorts of folks you're looking to select and sort of businesses you back. This is potentially a bit of sort of inside baseball of a question, but how do you select for systems thinkers that also bring the other attributes that you need to have that bias to action to achieve what you need to achieve on a venture timescale?
When we started out 2022, we had a very strong emphasis on systemic change, and even it was a lot about impact capitalism and the intersections, or how also regulatory, behavioral change, mindset change are all intertwined with the development of novel technologies, impactful technologies as such, which you could say is our core business, or is our core, it's our own product, so to say, funding and then accelerating or making sure these teams are more successful in building and rolling out these technologies with us on board than without us, hopefully, always to be judged in hindsight. We came to realize over the years is that it is really difficult and focus as a VC, but also as for the entrepreneurs, matters a lot. And while we still have a strong, let's say, convictions and opinions on the systemic change level, we have admittedly in the last 2 years or so spent much less time interacting with academia, policymakers, intellectuals, etc., because we simply came to realize what we are doing is so competitive, and the market, starting with the 2022 VC market downturn, and then the whole anti-ESG, anti-woke movement on top of that. Yeah, the market environment is a really difficult one, and it is not a walk in the park to even make the core business as successful for all the stakeholders. And it deserves, or it needs a lot of focus. And to do that, and to excel in our core business in an absolute adverse market environment, we actually sacrifice a lot of the initiatives that were more targeted at indirect impact and that were basically outside our core product, driven by our motivation and by our, let's say, philosophy, yeah, but still not very easy, palpable to our core stakeholders, which are the entrepreneurs as the customers of our business as a VC, yeah, and the LPs as, let's think of them as the shareholders of our business. And so therefore, in the bottom line, while this is still an important part of the DNA of the new, we realized it is very hard as an emerging manager in an adverse market environment to at the same time achieve outcomes or take an approach that almost blends a little bit of a think tank into a VC. This you can do, I believe, from a position of being super established. Yeah, Berkshire Hathaway can do that. Sequoia can do that. BlackRock and Blackstone could do that, yeah, and are unfortunately not leveraging the potential that they have there also to forge public opinions, although some of them tried at least for a while. But for an emerging manager, it's a really tough ask, and it's always, and this is the same for the companies we're backing in the first 3 to 5 years, they are most vulnerable, and it's already statistically the odds are always against you when you look at multi-stage, survival and success rate. So therefore, today I have a bit of a different stance on how we should focus the scarce resources of these only like 12, 15 people, so that we have on direct impact creation for our key stakeholders, or we have direct influence, etc., versus the more indirect stakeholder ecosystem, thought leadership, etc. But I hope at some point in a few years to come, we will arrive at the stage where this can take again more capacity in our day-to-day resource allocation.
You've kind of challenged a little bit the classic VC model with trying to look at how to create system change. And as you say, sort of found out that it's maybe a little bit hard in the current position. You also started out as an evergreen fund, but then changed away from that. So what are the things where you think, okay, here we can challenge the model and where you've sort of kept on challenging it in terms of longer holding periods or other things? And where the things, for example, evergreen, why wasn't that possible in reality?
Yeah, so this, I mean, is a case in point, speaking of systemic change here, systemic change to address the fundamental, what I believe, fundamental flaws of venture capital as an asset class. And while the lack of impact of this asset class over a multi-decade evolution or context is what we are obviously still addressing today, even as a closed-ended fund with our own methodology, with the strategy that we deployed, etc., the impact we report and measure it, and so on and so forth. This is something that we were able to successfully retain, and where we were able to also convince an entire set of reputable institutional limited partners to come on board and trust us and forge a long-term relationship with us. However, the other parts, speaking again of the fundamental flaws of VC, like the lack of accessibility to the broader population, the young professional, the retailers, so the people out there. Yeah, essentially everyone who's not an institutional investor and who's not ultra wealthy and qualifying semi-professional running his own family office. Yeah, the lack of accessibility persists. Yeah, and the lack of long-term interest alignment for really the full journey, which can take from inception to IPO, can also take 10, 12, 14, 16 years. But even those few companies that make it to IPO, from my perception, wish to have some of the early cornerstone investors and board member to even stay on and accompany them even beyond this exit transaction or this big milestone, if you will. And again, the traditional 10-year VC fund cycle is not really built for that. And even less so when we're talking deep tech and hardware deep tech development, where sometimes it can take years to first revenues, to commercialization, not comparable to, say, e-commerce platform or enterprise SaaS era, where we're talking 6 months, 12 months to commercialization and also faster time to maturity and to exit. Yeah. And other aspects that we tackled with the evergreen structure were even around the incentivization of management working with carried interest that would work more in a sense of stock options and making all everyone from the management share within the fund as opposed to like a carried interest scheme that is more like hit and run. Yeah. And working with lockup periods, so almost more emulating stock option schemes for corporate C-suites, yeah, rather than the hit and run carry scheme that you see in venture capital and private equity. This is the mainstream. To give you some background, right? This can be a multi-hour conversation, but essentially these aspects around accessibility, long-term stakeholder alignment to the entrepreneur, but also to the LPs, and also then lastly, a lack of liquidity in the asset class, where certain, secondary market transactions happen here and there, but essentially one issue why VC is not unlocking more capital for the asset class is also the 10 or 12 year illiquidity, the little control the LP has about its destiny and about the exact timing of distributions. We were also working, or we actually had in place a gated redemption scheme where LPs, after an initial several years of lockup period, can hand back at own discretion once a year on the NAV, based on the current NAV, could hand back a bit like in a mutual fund, you're in a hedge fund, certain portions of their shareholding. So therefore, I have more control over the divestment, not just the investment. Yeah, but that's not an easy one to manage from a liquidity standpoint when a lot of your underlying portfolio is essentially private markets or illiquid. Yeah, so there's many challenges to it. But these fundamental challenges of lack of accessibility, lack of liquidity, lack of long-term stakeholder alignment were the drivers for us to set up a truly groundbreaking innovation fund structure and Luxembourg law that has been that where there's no role model for it. Yeah? It has some elements of a Berkshire Hathaway, some elements of a hedge fund, some elements of a multi-stage fund, you could even say from a VC or cross-border perspective. Yeah? And apply that, build a large and diversified portfolio of climate impact companies that would at some point even be, from a diversification standpoint, a risk profile, even be a good fit for retail investors and for the democratization of the asset class. And this we did, and we did succeed in structuring this and also in raising the first tens of millions, but not hundreds, mostly from family offices or high net worth individuals. And then not only the market turned and the VC bear market started, but then also we found out after several meetings with tens of institutional investors from Europe that ultimately none of them would be really able to get an investment in such a innovative structure through their investment committee. They could like the team, like the strategy, the track record, all of that. Yeah. But that was ultimately the realization. So we were at a point to either exclude a very meaningful part of the entire addressable LP universe or to accept the message and adapt our fund structure. Not necessarily anything giving up on any of our impact-related methodology and climate tech focused strategy. That was fine. That's where they followed, so to say, that part of the innovation, but they did not. The institutional market was basically systemically reluctant to structural innovation. And that was the realization. And it gave me sleepless nights, you can imagine. And ultimately, for the sake of unlocking as much or the meaningful amounts of capital into this strategy and being able to work with a larger number of companies and support them more meaningfully than we could have potentially done short midterm in the evergreen model, we then decided to listen to the message and adapted our fund structure, and then very successfully double, tripled our assets under management and attracted many institutional LPs that are today on our LPAC. And so in hindsight, it was probably the right decision when you think of impact also as a function of how much money do you put to work and how much of a catalytic effect does your money also have. Well, it is relevant for the, not just for the inception, but for the successful emergence of new impact technology firms. Therefore, in hindsight, probably yes, it was the right decision, but still it was a bit hard bleeding because we really were convinced, and I'm still convinced today, these fundamental flaws deserve a solution, and they can only be addressed with structural change or structural innovation. But the realization is it is very hard, again, to the point earlier on systemic change, it's very hard to do that as an emerging manager, especially in a tough market environment. Yeah, where in a bull market, people are more open for innovation or experiments, if you will. They're not so in the bear market. It's all about protecting and not making mistakes and backing off on anything that's not fitting, so to say, your traditional scheme. So this type of structure innovation, again, is easier to initiate from larger established platforms than from emerging managers. But certainly it is something that we keep on our agenda. And when the time is right, we will again see and test how the market, maybe in 3, 5, 10 years time, responds to the solutions that we have crafted to these systemic issues of the asset class.
Pulling on the thread that you mentioned just a second ago about some of the business models here. I mean, you've backed climate tech from the Earlybird platform. You've built AENU about this, around this theme of climate tech. What makes you certain that climate tech investments will deliver the necessary returns to LPs alongside that impact? And especially in light of some of the learnings from Clean Tech 1.0 and to an extent from the recent sort of RIP climate tech waves in the context of generating liquidity and DPI, especially from some of these investments. I'm just interested in your reflections on some of the learnings and how that maybe informs how you invest today.
Yeah, the hard learning from the last 12 months market environment, certainly it's that hardware is and remains hard be it in climate or elsewhere. But the bankruptcies of companies starting from, Infarm, Volocopter, Northvolt, Lilium, etc., that were all, you could all broadly count it climate-related hardware or hardware deep tech development that were well capitalized. I think shows how difficult it is, or how much more difficult it is to really succeed in a hardware deep tech development company compared to applying, for example, a climate interlock in an enterprise software or these days agentic AI model out there. And our response to that, we are software people at the core. Up until 3-4 years ago, we spent our life as entrepreneurs investors on the software side. So therefore, it also see us predominant investing in software-led models, software sometimes and blending into IoT. But we also maintain a pocket for the hardware side of things, because specifically many of the hardware or many of the climate moonshots, like let's say the gigawatt potential companies, often go hand in hand with touching, let's say, physical assets, touching real world changes, no matter if it's on some parts of the energy side, if it's on some carbon removal, circularity aspects, etc. We've recently invested in a company in thermal heat storage to replace the gas boilers out of Paris, France. We're shareholders in the likes of Heirloom and carbon removal side, Atmos and others. Yeah, and therefore we do maintain a pocket, but we are very thoughtful of our own limitations when it comes to hardware deep tech investing and how we build the syndicate with other co-lead investors that come originally much more from a deep tech hardware background and have a even much stronger engineering DNA on the team than we do. So it is not easy, but it is part of the solution. It's a necessary part of the solution, and we reflect it in the way we build syndicates and also how these few investments are led by our in-house research and thesis, and how we are, let's say, very specific about what we're doing there. And also we've become much more proficient to the financing architecture, from mezzanine to revolving credit lines, project finance, forging ties with innovative green infra players that kind of come downstream and go earlier and earlier. And you see them these days even sometimes playing at Series A, where 5 years ago they only came post-IPO, basically. So things are changing, but hardware remains hard. It is much easier to generate the classical VC rate returns when you stick to the software lab place, and there go look for strong interlock of climate returns with commercial returns. And there the from a KPI standpoint, the patterns that we're looking for in terms of year-over-year growth, margin profiles, net revenue retention, whatnot, do not differ much from how generalist firm would look at a non-impact related software.
Compared to Climate Tech 1.0, are there any things that make you more certain that the return will be there now, also on software solutions that were not all successful in Climate Tech 1.0 either?
Yeah, I think one core learning of our firm, and also of personally, investment thesis should never rely on political and regulatory tailwinds, because they can change, and they can change more quickly than you think. So for us, it's really important that these companies are viable on a standalone basis and are not dependent in their success on a certain tax exemption or on a certain subsidy scheme or whatnot. Yeah, VC is a long-term game. You're typically, especially for the better and best performing companies, we're talking 6, 8, 10 years holding period often. Yeah, and on those timelines, things can change a lot in the world, not just country by country. So certainly not relying on products or business models that are dependent on regulatory or political support, and then also not relying on the willingness of customers to pay a green premium. We are very much looking for what we call commercially superior climate solutions, where the commercial ROI in and of itself is so visible and so near term that the purchasing decision, I'm talking mostly about B2B, we do 90% B2B, the purchasing decision of the client is typically not primarily driven by the decarbonization agenda, but it must make sense commercially with the climate benefits and the benefits for the net zero goals, etc., coming on top. If it's the other way around, your addressable customer universe goes down 80% or so these days. It was different 3 years ago. We don't know what it's going to look like in 3 years. When you apply a Gartner hype cycle, maybe even not so bad in 3-4 years' time, when we're at maybe 1.7 degrees or whatnot, and also the GDP level loss and the dauntingness of weather extremes becomes more and more palpable to more and more people in the Western world every month, every year. Yeah. But right now, don't bank on green premium.
So we'd like to end each of these podcasts with a couple of tips. And firstly, I'm going to ask you for what your best tip for generalist VC investors is about impact.
My best tip is to generally stop thinking of impact as a trade-off to commercial goals. And this is because mid and long term, the convergence, it can be Trump administration and whatnot, yeah, but mid and long term, the convergence of what makes from a societal and environmental and climate perspective, what makes sense for humanity to survive is increasingly converging with what is desirable from a GDP, from a wealth perspective. So ultimately, these lines are more and more converging, and maybe they're not like this, like two straight lines. Maybe it's more like this. Elasticity, yeah. You have this administration, that administration. But by and large, the allowance for unpriced externalities will become more and more marginal because society cannot afford it. And you can be populist or green or left wing, right wing. Ultimately, this is a realization. Also, the populist's home in LA is not getting insurance cover anymore. Why? Because of climate crisis. And why do we have climate crisis? Because we haven't priced carbon emissions for 150 years of industrial age. So ultimately, everything connects, and it all comes together. And therefore, my best tip or my advice is for generous VCs to think mid-long term, much less impact as a trade-off for short-term financial returns, but more trying to watch like really the underlying mega trends. And yes, there is AI, there is robotics, there is certainly defense in Europe these days, all for good reasons. But even more so, there is the unresolved climate crisis getting worse every year. There's biodiversity collapse gearing up to be the next big wave, yeah, with even more systemic impact at a global scale potentially than the climate crisis. Yeah? Also mutually reinforcing, especially the climate part for the biodiversity part. And that's where we are talking trillions of GDP and hundreds of millions of lives basically at risk. In my lifetime, I mean, I'm 42 years old now. I'll still be in business for a few decades. This will increasingly converge. Yeah, basically, my ask also to the generalist VC and PE and all other type of asset classes out there is to stop thinking as a trade-off and join this movement and start to gradually integrating impact considerations into their strategies. It will pay off. There's no way around it, and it will become more obvious every year.
And if you had to give a tip for other impact VC investors, what would it be?
Be rigorous on the commercial side and demand from the companies that you back, demand feature parity to legacy solutions, demand a path to price parity to legacy solutions. Because if you compromise on that, you end up in the green premium bucket and you will not be able to generate market rate returns. And that is not serving the systemic transition towards unlocking more capital for Article 9 strategies in particular. So it's almost like impact investors, we have a collective obligation to be fairly strict on the commercial view to make sure this asset class is attracting more capital for societal and environmental benefit. And we are basically, with the performance we're showing, able to convince more and more mainstream investors to let go of their perception, oh, this is making money, this is charity, right? That's where many people are still stuck since decades. And there's still a way to go to break up these old patterns of thought and these beliefs.
I think that's a great way to finish off, Fabian. I think it's good with also just a small wake-up call sometimes for both the generalists and the impact VC investors out there. So thank you so much for joining, Fabian.
Thanks, August, and also for some of the more challenging questions here. And Dagi, it's great to see you again, this time on the screen, 2 weeks ago in person. I look forward to keeping in touch. Thanks for having me.
Super. Thank you, Fabian. Pleasure as always.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
It's a lot of information to get in 30 seconds.
This was their finest hour. Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.